What's going on, Wisconsin investor audience? Welcome back to another episode. I've got an amazing guest for you guys today, a very timely guest for you guys today. We are going to be getting into the big, beautiful bill. And so regardless of your political affiliation, we're going to have a lot of great information for you as a real estate investor out there today. And I'm going to introduce our guest here in a second. Before I do, as I do on every episode, I'm going to talk about our sponsor, Wisconsin Discount Properties. As you guys may or may not know, if this is your first time listening, we drop off-market deals in your inbox every single week at 6 a.m. if you're Central Time. And these are all heavily discounted properties. We've got our website. We're working on improving and making some changes. We're about to launch some case studies on there to show you guys actually some of the deals that if you were on our buyers list that you missed out on, and you're missing out on some big numbers here, guys. So we're going to break that down. These are actually case studies. We've gotten the numbers directly from the buyers who bought these properties. And we're going to show you those. Another thing we're doing as well for our people who are joining our buyers list, if you join the buyers list, you can do that by going to the website, wisconsindiscountproperties.com, plugging your information in there. We are giving away my Burr for Beginners course. So at one point we charged $3,000 for this course. That was when I was doing some more one-on-one coaching along with it. We recently been charging $2,000 for just the course, and we're going to give it away for free now. So go to the website, fill it out. Connor Reese from my team will give you a call after you join the buyers list, and they'll tell you how to get that course. And you can start taking action on building real wealth today. With that, let's get into today's episode. I have Mr. Kaden Hackney with me from Beck CFO. Kaden just became a tax partner, I believe. Is that correct, Kaden?
Yeah, that's exactly right. We're real excited about it. Got a lot of energy for it.
Beautiful. Can you tell people what does that mean when you become a partner? Because I didn't know this with like law firms and accounting firms. Like I didn't understand what it means, but tell the audience, what does that mean? That's a big deal.
Yeah. So that means that for lack of better terms, I was able to negotiate a buy-in, be able to become an owner in the organization. So, with my partner, Marcus Krigler, we have decided to join carts together for the next foreseeable future.
That's awesome, man. And we had Marcus on maybe 10, 15 episodes ago. We were just talking general real estate tax strategy things. And then right before 4th of July, July 3rd, I believe, is when the big, beautiful bill got signed into law. And there's some pretty big implications, good, bad, or ugly, into that bill for real estate investors. And so Mr. Kaden here decided or reached out, asked if we'd want to have Beck back on and break down this big, beautiful bill. And of course, I jumped at this opportunity because it's so timely, so relevant. And I think it's so important for our audience out there, obviously in real estate investing, to know all about this bill. So Kaden, start out, man, wherever you want to take this. I know you've been doing calls left and right for our CG audience and for, your clients on the big, beautiful bill. So we're kind of getting maybe a refined version here, which is great. But tell us a little bit about what are some of the highlights of this thing that, real estate investors really need to be aware of and take advantage of going forward?
Yeah, that's a really great question. And I think, before I jump and dive into this a little bit, I want to, give you guys some context on how this bill has kind of worked itself through and
Cool.
even some upcoming changes that I'm expecting to happen over the next few weeks.
Okay.
So the bill got introduced back in March to the House of Representatives. They chewed on this and passed it in May. It went to the Senate, had some changes and revisions, went back to the House, and then finally, that House version got finalized, went to the president, got signed. Well, they, to all of us who don't work in Congress, it seemed like that was a long enough time to have gotten it right, but they felt like they were rushed. So even this signed bill, there's a lot of issues and things being identified that people actually want revisions and corrections to be made. So there's going to be a corrective bill actually getting passed here in the next month or two that's going to change some of this stuff. Oh,
wow. That's interesting. I know one thing I saw, I was reading an article today actually about this. It was about the gamblers, the people who are professional gamblers. They're fighting to get some things changed. There was something where you can explain this piece probably even better than I can, but it sounded like a bad deal for gamblers.
Yeah, gamblers, they were basically, if they went and made $1 million, but they spent $1 million to make $1 million, they were going to get taxed on 10% of what they made regardless. So they were only going to be able to take 90% of their losses against their income. So they're paying basically a phantom tax at that point on money they didn't actually make. And that's something that's definitely being lobbied to get updated and changed.
Yeah, it doesn't really make sense. Like, who put that in the first place? That seems kind of like, what?
I don't know. Frankly, didn't focus too much on it.
Not really relevant too much for us real estate investors, but interesting nonetheless. That they're like you said, they're making some revisions. But anything that you can see that you want to touch on with the revisions that are kind of juggling right now, that is up in the air, that may affect real estate investors?
Yeah. So right now, Marcus and I, we've kind of had this conversation on some of the prior calls that we've been on. This is the 5th one so far.
Okay.
We've kind of said, like, everybody's out there saying that these laws are permanent. And we said, yes, the law as it's written today says that, hey, this is not going away until someone comes and changes the law. And we're about to see potentially that, right now, bonus depreciation, this has been a big thing that the real estate community's been looking forward to and anticipating. It is back at 100%. So the rate is 100%. There's no stair step where it's sunsetting and going away anymore. And there's also no expiry date. So at least as the law reads today, 100% is here to stay. I don't know if anybody's trying to touch that.
Okay.
But that could be something where, hey, they're like, well, let's keep 100, but maybe we want to put, because, the first bill that got introduced by the House actually had 100% expiring, I believe, in 2033. So there was a timeline.
Okay.
And, the Senate removed that timeline. So I don't know if we see something shift there where our window of opportunity gets defined a little bit more clear.
Okay. Can you just explain, I've had Marcus on, I've had another accountant on here talking about bonus depreciation and what that is, but can you just explain to people who maybe this is their first experience hearing this, they didn't listen to those episodes, they don't know what bonus is. Can you explain why that's a big deal, why real estate investors have been waiting to hear about this for a while?
Yeah. So big thing in real estate, we're all trying to build wealth. Wealth is built through assets. And when we go and buy like a rental property or something like that, we may invest $300,000 into that property. And what happens is depreciation is how we are able to take a tax benefit over time. So a single family home typically gets depreciated over 27 and a half years. Well, what makes bonus such a big deal is real estate professionals, they can say, hey, we want to take that $300,000 and we're going to use what's called a cost segregation study. It kind of buckets it up, and 2 of the 3 buckets are qualified for bonus depreciation. Bonus depreciation at 100% says that those buckets get written off immediately in year 1, and that usually produces massive tax savings that helps strengthen the return on investment for that.
What's the bucket that doesn't get touched? So you mentioned there's 3 buckets. What are the 3 buckets, Kate? And then what's the one that doesn't get touched?
Yeah, great question. So when you buy a piece of property, I'll just break it down real easy using a dollar. Okay.
Perfect.
We buy a $1 rental property. Typically, we're going to split it into a store of value for land and then a building. Okay. The store of value for land, the golden rule says that's going to be a 20% store of value, and then we get 80% taken into the building.
Okay.
The cost segregation study is going to split that 80 cents into 3 buckets. One is going to stay the building. The second will be land improvements. And then the third will be fixtures, furniture, and equipment. Land improvements is a fancy way of saying landscaping, sidewalks, your driveway, those kind of things, fencing, stuff like that. Fixtures and furniture, that's going to be stuff like flooring in the house, light fixtures in the house, HVAC, could be, appliances in the kitchen and the bathrooms. It's those kind of things. So your land improvements in the fixtures and furniture and equipment, those qualify for bonus, and those get that immediate write-off with 100%.
Okay, got it. I always wondered what the one was that didn't stay. Now, what the important part about that for people to know is, like, so when you're saying this dollar, right? And correct me if I'm wrong here, but if I had to write that off, basically the 80% or what percentage is it usually that you're writing off of the not the land, but everything else? What kind of percentage?
Yeah, so kind of break it down. You take 80%, and then usually on average, after seeing thousands of cost segregation studies, you're typically going to see about 25% of the building value get put into those depreciable classes that qualify for bonus. So, a good rule of thumb is 20 cents per dollar you invest is what you could expect to have as a bonus write-off with a 100% bonus.
Okay, so in normal years, you'd have to take that 20 cents and then divide that by 27 and a half, right? And then every year, that's your write-off, correct?
Not quite. So the 27 and a half, you take the 80 cents, divide that by 27 and a half.
Okay.
That's typical. With the cost seg, you end up saying, okay, 80%, we take 25% down into those bonus eligibles. We write those off. The remaining 55, I think that's right, 55 cents, that gets split over 27 and a half.
Okay. So the other buckets that you're talking about, are those a faster, normally is it a 5 and a 15-year depreciation schedule? Okay. So that is kind of where I was going with this for the audience. So the 25% that Kaden's talking about, or whatever that smaller number is, normally you'd have to take those in either 5-year depreciation schedules or 15-year depreciation schedules. So it's a smaller tax write-off basically every single year. What Kaden's talking about is you can accelerate that into 1 year, and now you're getting a big lump sum write-off. And what's important about this, Kaden mentioned real estate professional. Kaden, can you talk about what is a real estate professional in the eyes of the IRS?
Yeah, so the IRS defines the real estate professional in Section 469. This isn't like a license. It's not like, oh, I'm a realtor, I qualify. It has nothing to do with that. It has everything to do with what you do and how you spend your time and what you own.
Okay.
So you have to get at least 750 hours in a qualified real estate trader business. Real estate trader business, you can think of property management, land development, like a real estate brokerage. You can be realtor. All of those type of activities are qualified real estate activities. You have to have 750 hours.
Okay.
The next kind of thing that really matters there is going to be what's called material participation. This is where ownership comes into play. You actually have to own at least 5% of the asset that you are doing the real estate business in. So if you own 5% of a partnership, your hours can qualify towards that material participation.
Okay.
So material participation, there's 7 different tests. I won't get too deep into it. Your accountant can probably help you figure that out. But it's just checking some boxes, to be honest.
Okay. And so what you're basically saying is if you're just a real estate agent out there, you don't own any assets, you're not going to be able to, obviously you're not going to have a property to write off anything with in the first place, but you would not be considered necessarily for this purpose, tax purposes, a real estate professional.
Yeah. It really depends on how you get paid. So a lot of realtors that I see, they're contractors for a brokerage. So they're technically business owners. Okay. And those hours that they spend in that business would help towards the bucket.
Okay.
If they don't have assets, though, it doesn't.
Yeah,
really
there's nothing to write off. So yeah, it's kind of it's like a chicken or an egg thing. You got to have one or the other there to get the tax write off, right? So that's important, guys. One of the things that I think is interesting, Kaden, again, correct me if I'm wrong on all this stuff, but one of the examples somebody explained to me this a few years ago when bonus was 100% when I was getting going, is they said, like, imagine you're a doctor and you're making $500,000 a year. Something like that. You're heavily taxed, right? You're a highly taxed individual at that on your W-2. Let's say your spouse is you guys own some properties and your spouse is managing said properties and they're hitting these litmus tests and now they're able to become this real estate professional. Theoretically, let's say you had enough depreciation to wipe out the $500,000. That doctor could essentially pay $0 in federal income tax. Is that correct? Am I explaining that correctly?
Yeah. There's definitely some limitations on how much you can do, and I have a good example.
Okay.
Of when that doesn't quite work out as how you would expect. A client of ours who has, almost that exact situation. One of the spouses is a doctor, makes really, really high wages through their job, and the other spouse is a real estate professional. Well, part of the old Trump 1.0 tax bill, it introduced this thing called excess business loss. Okay. that put a cap on how much business losses could actually offset non-business income, like your wages, your interest, your dividends, capital gains type income. So we've got, for a married couple, you can only offset up to $626,000. So if you've got someone who gets like a $700,000, $800,000, $900,000 W-2, you're going to get hit with a little bit of an issue there if you're trying to use depreciation alone to offset your income.
Okay. Interesting. I never knew that. See, that's why we do this podcast, man. I learn something new every time. It's great.
There you go. So the big beautiful bill has now extended that excess business loss limitation and made it permanent as well. So it's not going away. It's here to stay.
Got it.
Where one of our clients is kind of in big trouble with this is they use business losses, and then the way that they kind of still were able to get out of paying taxes was using itemized deductions. They'd do large charitable donations. So they'd go and use they did a conservation easement. They've done a leveraged asset donation. These types of things. It's basically you go and either give an asset that has appreciated in value, you get a large deduction from the IRS. You don't pay capital gains on it, or a conservation easement is saying, hey, I'm willing to restrict the use of some of my land and give that to the government, and they'll preserve and kind of take care of the land for the wildlife and the plants and all that. That's what those two things are. Nevertheless, a new limitation on itemized deductions got written into this tax bill, and we actually did a big case study about this, kind of led with this almost with folks. Not everybody's paying less taxes from this bill. This particular individual in 24 paying zero. That same situation against the new tax bill, they're paying $216,000 of federal taxes because the laws changed.
Wow, that's insane. Okay, so let's break that down for a second, Kaden. So what were the issues then, or what are the issues now with the beautiful bill on those two particular examples there of the easement and the leveraged asset donation? What changed? Is it just that limitation that you were talking about?
Yeah, so we went from essentially no limitation on the itemized deductions that was coming into play versus now for folks that are in the 37% tax bracket, that's the highest income tax bracket, they have to do this crazy calculation where they take their income and subtract, it's about $578,000. That's where a married couple crosses into the 37% bracket.
Okay.
And they can take 3/7 of a dollar for everything over that 578. So if we're talking a million, I'll get a little calculator out here.
3/7. Again, who comes up with this stuff?
Yeah, Congress. They love to scratch our heads, right?
Oh my goodness.
So if you had $1 million of gross income, you have to take that and subtract 578 and then multiply that by 3 divided by 7. That means your max itemized deduction is only $181,000. So you have $1 million of income, you can only reduce it by 181,000. You're left with the difference.
Wow.
Right? And now you pay a lot more taxes, and that's what will happen if we don't change something. So we're one, hoping for some changes in this correction bill. Maybe they didn't mean to reduce the benefit of charity so much, because it seems kind of crazy to place such a big restriction on how charitable someone could be,
right?
Get benefits for it,
right?
But otherwise, we're talking to them about, hey, do you have any way to do like a deferred stock option with the spouse, or is there, maybe another retirement plan? We could put more of these wages, reduce the non-business income, so we're not so exposed.
Okay, so let me just give an example. Let's say I make $1 million in wholesaling, right? And then I buy enough buildings where I've got $1 million of bonus depreciation I can take. Are you saying I wouldn't be able to take that whole $1 million of depreciation now, or is that separate from what you were describing?
Yeah, great question. So in that case, your wholesale, I'm assuming that that's your wholesale business, right?
Right.
Yep. So your wholesale business is business income. Business losses can offset business income, no problem.
Okay.
Yeah.
So but they're separate. We have separate entities. So let's say we have a holding company LLC versus our S Corp LLC. S Corp LLC is the one generating the wholesale income. The holding company is going to be just a pass-through entity. Does that matter?
Yeah, so in that case, assuming that you have what's called basis is basically the tax bank account that allows losses to pass through, which in a
Okay.
holding company should be no problem. I think I could spend an hour talking about basis. So for listeners, you might want to talk to your accountant about what that is, to be honest. At any rate, the losses from the holding company will pass through. The income from the S corp will pass down. Everything will kind of get reconciled dollar for dollar down at your personal return. So in that situation, you should be fine.
Okay. All right.
Yeah.
I'm like sitting here listening to it. I'm like, dang, if we good year, we might be screwed paying a bunch of taxes no matter how much depreciation I take. Oh my goodness. Talk about the downsides of bonus depreciation, because I know the government's not going to get paid, at some point. So talk about what are the risks of doing some of these accelerated depreciation schedules.
Yeah, so this is a really, really interesting conversation. Depreciation, I don't know how other people define it necessarily, but I call it, an interest-free loan from the IRS. It's not really accruing interest. You will pay it back later, and you get to choose when. So you don't have to accrue interest over time. You get to know exactly how you're exiting, and you get to choose when that is. Right? That's one of the best forms of debt that you could carry.
For sure.
Very, very favorable. So when we go and take these accelerated write-offs, we're lowering. I'm going to use that word basis again. So your asset, let's say you bought it for $300,000. Okay, this is something that where I'm going to kind of break up two different calculations and try to keep it simple.
Okay.
Real estate investor says I bought it for $300,000. 5 years later, I sell it for $450,000. I made $150,000. Right? That's what logic says. Okay. The IRS is going to say you did buy it for $300,000, but we gave you a tax saving benefit and you wrote off $100,000 of it. So in their eyes, they're going to say $450,000 minus $200,000. They say you made $250,000 actually. Okay. So the two equations look a little bit different. You're getting taxed on higher level of income. The way that we want to look at this, though, and why this makes sense is, let's say that you did write off $100,000 and it was in year one, and you're saving at a 40% tax rate. You just saved $40,000 today.
Right.
Well, that $40,000 goes back into your business or back into your pocket. You get to hopefully use that money to drive more wealth growth. So, that $40,000 over 5 years hopefully turns into, $60,000, $70,000, $80,000 of value to you. And now it's made borrowing those benefits from the government way more valuable and beneficial to you, so that when you pay the tax back later, it still made sense.
Right. Yeah, I've always been told, and correct me if you're wrong on this, but $1 today is better than $1 tomorrow.
That's exactly right.
Our dollar continues to lose value every single day. And so if we can use that dollar today to create more than inflation, then why wouldn't we use that today to beat out inflation and get ahead of it, right? And create some wealth, right?
Exactly. And an interesting case study that Marcus and I went and looked at, there's actually some potential where today in a wholesale business, if you're in the highest tax bracket income bracket, it's going to be really, really interesting to look at the numbers. If you go and let's say you make $30,000 in wholesale deal, and you're in a 40% tax bracket, you're going to pay like $12,000 of taxes. So your after tax profit is only $18,000, right? Well, if you take that property and look at it and say, what if we actually just kept it, and we're going to, instead of wholesale it, we're going to get it, we're going to put some dough into it, we're going to keep it as a rental. All right, let's say that rental, you're all in $250,000. Let's say that your ARV is, after repair values, $333,000. So you've got some equity in there
Yeah.
of 83. Let's say that you were able to get loan to value at 75%. That means, that's a successful BRRRR is what I'm giving you the numbers for.
Sure.
Right?
Yep.
So you don't really leave anything in the deal. You've got this equity. The tax savings on that $250,000 asset with a cost segregation study, what do you think that comes in at? We just said your after-tax deal is going to be 18 grand. Surely you make less, right?
Well, dude, it's going to be insane because now if you can accelerate that depreciation, I'm just going to do some basic math here real quick. I don't know. You're probably going to save 40 grand in taxes, right?
Yeah, it's maybe not that high, but point is 20,000. That's about the number you're going to get.
So you go from that's a $38,000 swing is what you're telling me, just in taxes.
Yeah, basically. Exactly. You go from having to pay 18 to getting 20.
Yeah.
Well, now if you kind of look and try to compare more apples to apples, though, you get 18,000 of liquid cash if you sell and do the wholesale, or if you execute it as a rental, you actually get more money back in your pocket, and now you have the store of value as an asset.
Right.
So you're building wealth.
Oh, that's good, buddy. That's good. We need to get somebody to go put this into actual numbers and break it down on a little screen, because that was really good right there. I'm tracking. I just hope the audience picked up on that, but that makes a lot of sense versus, I think that's one of the things that we've always done. We wholesale, but then we hold assets as well. So we're wholesaling, holding, and the holding is to offset the tax implications, right? The cash is to live off of and to, pay the bills today and do all that kind of stuff. But the goal is to you buy enough assets that I can write off a good chunk, if not all of that federal tax.
Yeah, exactly. And Corey, for you, I'm happy to go and record a piece of content that you can share to follow up with that and kind of show those numbers broken down to see the apples to apples. I've got that ready to go for you.
Let's go, buddy. We will put that all over the socials and we'll throw it up on our website as well. That'd be awesome. We'd love to see that.
For sure.
Perfect.
Now, the big key for people listening to that, this only works if you're in a high tax bracket. If you're in the lower tax brackets, the numbers, the math doesn't math for you.
Okay.
And my recommendation at that point is go make more money. Don't worry about the taxes. Go make more money.
Get yourself in that higher tax bracket, then start worrying a little bit more about how the numbers are going to pencil out this way.
Yep, exactly.
Okay. Got it. That's good stuff. Going back to the big, beautiful bill here, Kaden, what are some other things? Are there other things in there as it sits today that real estate investors are going to be keen on, or that you guys are talking to your clients about?
Yeah. So a few, I would say, this is probably more basic. It probably gets skipped over a lot. The tax bill is extending and making permanent our lower tax rates. So if you look back at 2017, before Trump passed his first bill, the highest tax bracket was actually 39.6%. We're now at 37%, and that's, not set to increase. So just by default, we're, got lower brackets. The width of the brackets are bigger. So you end up, scaling to those higher tax brackets much more slowly, and you pay less taxes as a default. And that's for everybody, rich or poor, no matter what, everybody's getting a tax break that way. Okay. Got the standard deduction. I think something like 70 or 80% of taxpayers are using the standard deduction. That's a gimme from the government saying, hey, for you single folks out there, $15,750 is not getting taxed. For married couples, that's $31,500. We're not going to tax you on the first, fill in the blank amount. Okay. So that's a gimme to everybody. Before the Tax Cuts and Job Act back in 2018, those numbers were like 6,000 and 12,000. So
holy cow. Yeah,
almost tripled. And now they're here to stay at that higher rate and keep growing with inflation. So big deal there.
So they actually put some things in there to keep up with inflation as well, with the standard deduction. Okay.
Yep, the standard deduction and the tax bracket. So today, the highest tax bracket you cross at 578. Next year it could be 600,000, for example.
Okay. Yeah. Well, that's good. I didn't realize that. Has that always been that way with tax brackets, or is that new as of 2017 or of 2025?
Yeah, it's kind of always been that way. The law is kind of writing because they're noticing that the rate of change is faster. So
Mm,
they're trying to keep up with, what year they're basing it off of. So prior to the Tax Cuts and Job Act, I think it was like 2006 or something that they were saying, all right, we're basing all of our adjustments based off of the 2006 market. And
okay.
then they adjusted it up to 2015. Now it's 2025, and they're going to more regularly take a look at that for us because we've all been here. Prices have been jumping really, really high and
Yeah,
really fast.
for
So
sure. For sure, buddy. That is the truth right there, my friend. What else you seeing in there, Caden? Give us some more dirt. What else is going on in this big old 900-page beautiful bill?
yeah, so this was a provision that got introduced and was going to go away after this year. It's called qualified business income deduction.
Okay.
This is for every business out there that's a qualified business, which most businesses are qualified businesses today.
Okay.
I think you could go and look up the exceptions. Is what I would recommend there. So real estate businesses, if you're doing like a wholesale business and you got $1 million of profit, as long as you kind of check some compliance boxes, you're going to get a 20% haircut off the top. So let's say that you can't go and use all the bonus depreciation, and that's not something that's all on the table for you. You could get up to a $200,000 deduction given to you by the government through this qualified business income deduction.
Wow.
And that's a free 20% discount. You
Yeah.
know,
That's awesome. And is this new in this bill, or was this something that was in previously as well that was sunsetting, or what? Where did this come in?
Yeah, so this got introduced back in 2017. It was going to go away after this year, but again, this one's made permanent. And there's actually been a little bit of misinformation on it because there was like differing rates getting thrown around. The first bill said 23%. The Senate changed it back to 20. It's still 20%. That's what it's always been. It's a
Okay.
20% discount.
Okay.
But it's here to stay now. It's written permanently into the tax code until the law changes, right?
Yeah. Until the next administration comes in and says, I'm just kidding. We're going to change that
Yeah.
now. Yeah.
So
Yeah.
and honestly, that's my curiosity is a lot of these things that don't have an expiration date. I wonder if they come back and say, we want to put an expiration date.
Sure.
2030, 2033, something like that. Because when they're not charging us taxes, they've got to pull that money from somewhere.
Yeah.
So,
Yeah. Well, that was the hope with Doge, right? I mean, again, regardless of what side of the political aisle you're on, I think every American agrees waste and fraud is probably not good and nobody wants to pay for that, right? And so you look at like where can we cut funds and money from spending so that we aren't getting taxed. I mean, we get taxed on so much stuff like property taxes, sales tax. I got a wheel tax in our county or in one of the counties here for the road system. And you just get taxed through the gills and you just kind of get sick of it after a while. And it's like, give us a break a little bit. Yes, we all need roads. We need social net, safety nets, all that good stuff. Everybody in America is on board with that. It's just, how do we pay for those things? And then what are the things that we can get rid of so that we can all pay less in tax is ultimately I think the heart behind what's happening right now. And everybody has disagreements, I'm sure, on how we get there and what's considered waste versus so some people is maybe different to other people. But I think the heart is there that nobody likes paying taxes. It's not, that's
right.
why our country was founded on the fact that we hate paying taxes. So I think that's just in our DNA here in America. So I think overall paying less tax is a great thing as long as we can figure out a way to still have the safety and the national security and all the other things that we want to be the best country in the world. Somebody's got to pay for that stuff too. So,
yeah, absolutely. Yeah, there's a couple of, a few more exciting things I think for the real estate world. This one's not new. It was introduced back in 2017. It was just going to go away. It's called opportunity zones.
mm-hmm.
I don't know if you heard of that.
Oh yeah. Oh yeah.
Okay.
But so you can go into that. Our audience, this might be new for our audience.
Okay, cool. So an opportunity zone, the government went and defined qualified areas. There's actually like a website you can go and see the whole map of the U.S. and it shows exactly where these areas are. So typically going to be, lower income areas, places that maybe time has eroded some of the luster of the neighborhood. So the government says, hey, if you go and create a qualified opportunity zone fund, so this could be something where you go into a fund like we think about a bunch of people together. This could also be an LLC with the right paperwork that got set up the correct way and qualifies as a fund, and more of a self-directed opportunity zone fund. Okay, so a few different things going on there. What the government has kind of written into is this is an alternative, business strategy exit.
Okay.
If you've got, let's say, a big portfolio of assets or a business that you're trying to sell, something that's going to result in a lot of capital gains, the government says, hey, let's say that you've got, $2 million of capital gains. If you go and instead of keeping that $2 million, you put it into a qualified opportunity zone fund and invest that $2 million into an opportunity zone, we're going to give you a little bit of benefit for doing this, a little incentive. Okay.
Okay.
So you'll take that $2 million, instead of paying taxes today, you get to defer it for 5 years. Okay. So you're not going to pay that tax today. And in 5 years, if you've held that qualified opportunity property, so the thing that you invested in with the money, if you've held it for 5 years, we're going to give you a 10% discount on your taxes. So, $2 million at 20%, that'd be like a $400,000 tax bill, right?
Yeah.
Well, they're going to give you a 10% discount. So you're in 5 years from now paying $360 instead.
Okay.
So that's benefit number one.
Okay.
The big benefit is if you hold on to that qualified opportunity property for 10 years, they're going to give you a 100% tax-free exit on that qualified opportunity property. So let's give you some for instance. So $2 million that you put in your capital, let's say that you went and bought a $10 million asset.
Sure.
Okay. Let's say that it was real estate assets. You're going to take depreciation on it. You're going to write it off. Get some huge tax benefits for doing that today, right? Well, 5 years into it, you're going to pay the taxes on the deferral and at a discount. Well, 10 years into it, let's say that $10 million investment is now a $20 million asset value. You bought for 10, let's say that you've depreciated half of it. So you've got, $5 million of cost left. Well, on paper, the tax side of it's going to say, all right, 20 million minus 5, $15 million gain. So you're going to be expecting a $3 million bill. That bill's going to be zero. You don't even recapture depreciation in this opportunity zone exit.
Wow. Crazy. That is crazy. Holy cow. Yeah. How popular are these things, Kate? Are you seeing this with your clients? Are they doing this, or is it not as common as what it maybe sounds like it should be for that kind of benefit?
Yeah, well, here's the kick. So this was brand new back in 2017. This stuff was like so new and so out there. It was so difficult to understand the workings of it that by the time everybody understood it well enough to actually do something with it, the benefits were just not there anymore. You were going to get to defer for 2 years. 2 years doesn't, make the math make sense.
Right.
So this is, in my opinion, this is awesome that we're now getting to know about it and execute on it and use it now. And it's going to be there and available for us, at least as the current tax law is written, it's there permanently now.
Yeah. Wow. That's crazy. I never knew that you could just get your own LLC with the right paperwork. Like I always assumed it had to be some big kind of syndication you were getting involved in or something else. But it sounds like what you're saying is it could just be me, go get an LLC, get my attorney to get the right opportunity zone docs.
Well,
and
that kind of speaks to what I'm saying is the reason that we all thought that was because the big firms that could, act fast enough to put all these deals together, they just did it for the masses, and it was it was a little bit more costly and expensive for one person to go do this. Well, now
Sure.
we've had experience, people can do it and know how to set that up correctly.
That's awesome, man. Like, I mean, I'm just thinking about my own portfolio and I'm like, man, I even just to diversify some of them into, can you 1031 into this thing? Like, could I sell something and 1031 in? Or do I not even have
quite. Yeah,
Okay.
it's not quite. So what you're going to take advantage of is that 5-year deferral. So instead of the 1031 deferral, you're going to say, all right, I'm going to do my 5-year deferral in my opportunity zone. And
Okay.
you're going to go for that discount. So this is kind of like an alternative to the 1031.
Okay. So if, let's say I'm just gonna try to understand this. I've got, say, that $10 million building. I made it's now I'm selling it for 20. I got 15 million in gain. I can now just take the 15 and go buy some opportunity zone stuff, or what's the play there? Because normally I would think, okay, if I don't want to pay tax, now I got a 1031 into something else with this $15 million, or it's got to be over 20, right? Whatever your sale price is at 1031. But what's the play? Like, how are you utilizing, an existing asset sale to take and put it into an opportunity zone, or is it like, what are people doing in order to get in the zone, so to speak?
Right. Yeah, exactly. AutoZone. Get in the zone.
Good marketing, AutoZone. We all know it.
There you go.
Now sponsored by AutoZone.
Yeah. Well, hey, maybe we go for it.
That's right.
Yeah. So what are people doing? They're saying, okay, I've got this huge thing, and this could be, some people might get forced into this because their 1031 didn't work out. There's all those time commitments. So I'm not saying that 1031 or opportunity zone is one's better than the other. I think it's all about your vision and what you're trying to do. The 1031, remember we talked about cost segregation in some buckets, right?
Mm-hmm.
The 1031 lets you defer the gain on land. It lets you defer the gain on the building, and it lets you defer the gain on the land improvement. You're going to be exposed for the fixture, furniture, and equipment depreciation you took no matter what. So 1031 doesn't get you out of that. You're still paying some taxes. You're deferring the rest of it. So you pay that tax today, you defer it, and you could keep that up all the way until you pass away. Well, the difference between that and the reason I say pass away is once you pass away, usually those assets get a step up in basis. The depreciation recapture is gone. You're moving on to bigger and better things. Your heirs your heirs are moving on to bigger and better things.
Yeah, your heirs are doing well.
You're gone.
Yeah.
Right. The opportunity zone, you're planning to pay the taxes in 5 years at a discount. Okay. So, you're going to save $40,000, but like we talked about, what is that money in your pocket today? That extra 360 now, because you're planning on 360. You get to have that money in your pocket today in the form of that opportunity zone fund and buy a big asset that you can plan a huge tax-free exit on in 10 years. So the opportunity zone can get you out of depreciation recapture in your lifetime. 1031, on the other hand, can get your heirs out of it instead.
Right. Well, that's what I'm trying to wrap my brain around. So I sell this thing for $15 million gain. I go buy something now in an opportunity zone. I hold it for 10 years. Now I'm out of the gain. Is that what's happening? I'm not paying gain on that 15 million that I sold. Is that right? Am I understanding this correctly?
So in 5 years, you're going to pay gain on that first deferral, right? So if you had a gain of 15 million and you're taking that into the zone, in 5 years, you're going to pay capital gains tax on that money that you put in and deferred. So you will pay some taxes. You get a 10% discount in 5 years. It's the new asset that you acquired with that deferred money. That new asset is going to be a tax-free exit.
Okay. So I get it. So I still need to stash away some cash from that sale somewhere in order
you need to plan for paying some taxes in 5 years.
Okay. Yep. And then in the new one, because that's what I'm thinking. I'm like, man, for our younger audience out here, this is a great opportunity for you guys not have to keep kicking the can down the road. Like with the 1031, you're just continually kicking the can down the road to avoid that tax. This is a way to actually get liquid without having to pay Uncle Sam in 10 years, right?
That's right. Now, there was some new tax law that was introduced on bonus depreciation in
Okay.
this bill. So this was actually kind of an exciting compound strategy that I think a little bit of planning and kind of deal creating could go into. And I bring this up because real estate entrepreneurs are really great at knowing how to partner with other people and take advantage of real estate driven moves, right?
Mm-hmm.
So manufacturing has a couple of different code sections that's coming into play. I'm going to focus on a specific code of bonus depreciation. We've been dealing with 168K depreciation. 168N, these are code sections. 168N is for qualified manufacturing activities or production activities. Okay. This gets really interesting. Let's say that we take that opportunity zone example. You're going to exit on some money and you're going to go into a manufacturing facility that qualifies as a qualified production activity. 168N is going to allow you to do not just like a cost segregation study and then writing off partial of that new building. It's actually going to allow you to offset 100% of the cost of that building. So if you take your $2 million of gain, and let's say that you and another person with expertise in manufacturing go into a qualified fund together, and you guys build a $10 million manufacturing plant, and you're going to make a bunch of widgets, and that person hopefully has some expertise. Well, that $10 million asset that you just bought, you're writing that off in the first year it's placed in service.
Wow. So is that the whole thing, or you got to still subtract out the land?
Your land is probably going to get some store of value. That's right. But other than the land, everything that's that manufacturing plant area. So if you've got a couple of offices, you kind of have to partition that out. You can still do regular depreciation strategy with your office building, but the actual manufacturing floor and everything there, all the equipment, everything that's in there, 100% written off. So in reality, of that $10 million, you're probably writing off, let's say $8.5 to $9 million in that first year. Well, that could be an awesome strategy to get you out of paying that 5-year tax that's down the road. You probably carry forward some losses to offset that. And what's crazy is 10 years later, you don't pay recapture on that.
Oh, wow.
The other
that's
clever
genius.
the other clever thing about this 168N is the government even says you have to use that facility as a qualified manufacturing or production activity for 10 years to avoid recapture, like instant recapture. If you change the use in like year 2, you're going to recapture that depreciation. So it says you need to do this for 10 years. Well, those timelines line up together. It's almost like they were trying to, hint to us, hey, we want you to do some manufacturing and we're giving you a way to have a massive exit.
Wow.
Without a recapture.
That's huge, man. I think when I speak to some of the audience here is probably like, whew, like I'm just getting started in real estate. This is not good. But for some of you guys out there that have some things going on, or you're even just thinking about your own stuff in the next, 5 years, I think what Kaden's talking about here is just some creative things, like using the tax code to really, again, it's not about what you make, it's about what you keep. And if you can keep all of, the profit of some of these things, it might take a while, right? 10 years is a long time in today's world, but man, that's a huge benefit to be able to, especially if you're hitting some bigger deals here. That's a big time benefit there to be thinking about.
Yeah. And I mean, I even see maybe some of us aren't at the scale to be able to go and execute that deal on our own.
Right.
But I'm sure that we start seeing some deal makers go and put together, a syndicated version of this where, maybe we're successful, but we're not at that stage in our wealth building journey, that maybe we can go and participate in some of this
for sure.
Regardless.
Yeah, that's exactly what I was thinking, man. Yeah, that's great, man. Any, Kaden, I know we're kind of bumping up against time here. Anything else that you think is really important that we need to get out about this big, beautiful bill here as it sits today that our audience needs to know before we kind of wrap things up for this session?
Yeah, I think going through this, we just talked about somebody who's going to pay more taxes. We just talked about how you could not pay any taxes, have huge exits without taxes. Hopefully that paints a picture that your situation could be anywhere on that spectrum.
Mm-hmm.
And it's probably really, really important for you to go and find somebody who's staying out ahead of this and is helping you, avoid pitfalls, take advantage of big benefits. We had a webinar, which, people are more than welcome to go and watch that webinar where we covered some stuff more in depth. We show you a lot of different situations where different things that sound the same actually play very differently on the board for you.
Okay.
I think, that's probably the message I'd leave, though, is find somebody who's going to work on this with you. We're happy to. If it makes sense to you, you can, go and visit us at beckcfo.com and get a free consultation to talk to us and see if it makes sense to work with us. But at the end of the day, go talk to somebody and don't wait until the end of the year. Do it now.
Yeah, this is the time of the year when, meeting with your accountant is probably the best time to do it. The big, beautiful bill has got passed. And if your accountant's on top of things, they're going to be able to look at your current year and how things are trending and be able to help start planning for year end stuff, right? Like this is probably one of the best times to be having these conversations with their accountants, Kaden.
Yeah, absolutely. And the thing is, the really good CPAs are going to have their doors getting kicked down and busted down. If you wait later, it's, more and more likely that you don't get somebody that's going to really take good care of you.
Right. Exactly. Yeah. And so guys, if you need some help, obviously Kaden clearly knows his stuff here, right? And if you're sitting out there and you're going, my accountant that I have, I think doesn't really know real estate. I think that's one of the best pieces of advice I got when I got started in real estate investing. Kaden, a mentor of mine said, go get a real estate specific accountant, somebody who knows real estate. And that's what you guys do at Beck CFO, right?
Yeah. Yep. So we're doing real estate accounting, real estate taxes, and real estate CFO services, helping people understand their business better, know the numbers, and hopefully keep more of their money in their pocket.
Yeah. And you guys do the books for us on all of our entities, which is awesome. You guys do a great job on that. So bookkeeping as well. Another important thing, it makes your accounting bill a lot lower when you have really clean books. So that's an important thing. You got to know your numbers too, and you got to make sure that you can trust your numbers. I found that out over the years is I could look at my books, but if I don't trust who's doing the input there, I don't really trust my numbers. So that's another important part too. So I highly recommend Beck CFO for that as well. Very reasonably priced for what you get in service there. They've been awesome to work with. I think we've been with you guys like 2 years now, maybe. And it's been really good. You guys have done it. We just switched all of our stuff. We had some lower volume things that we had a VA doing, and I just had to switch it because things were getting missed, and I just don't want to have messy books, man. And I trust you guys to do a great job, and your team always does. So we appreciate that. And guys, if this is overwhelming for you, or you're like, gosh, I don't even know where to start with this stuff, reach out to Beck. They got they'll hop on a free call with you. They'll talk some tax strategy with you and help hopefully get you started in the right direction. Because this is stuff you can take advantage of. Like you said, Kaden said, you can either be on one end of the spectrum where you're paying a bunch, or you could be on the other end where you're keeping a lot more of your money. But a lot of times it's the moves you make between now and December 31st, or maybe April 15th, some of it I know. But regardless, have that conversation sooner than later. Kate, we always wrap with one fun question. Now you're in Virginia, so this might be tough for you, okay? But I'm going to throw it out there anyway, and I'm going to see what you come back with. So do you have a favorite Wisconsin tradition or place you have visited or would like to visit here in this wonderful state of Wisconsin?
Yeah, so I've got a good friend that I met when we were doing some service work in Finland. He's from the Green Bay area.
Oh yeah, let's go, baby.
For the last 10 years, he's been hyping up Green Bay, telling me, "Oh man, you got to get out here. The nature's out here is beautiful. Going camping, There's beautiful, beautiful lakes." So I'm definitely. I still talk to him every now and then. I just need to get a trip planned to the Green Bay area. Get
it done, buddy. I'm going to hold you accountable to that. Our office is in Green Bay, Kaden. So if you are coming to town, let us know, and we'd love to have you come take a little visit and get to meet some of the crew there. It'll be a lot of fun.
Yeah, absolutely. Yeah, that'd be awesome.
Well, brother, I appreciate you taking time out. I know you're a hot commodity right now after all this stuff. Not that you're not normally, but especially after this bill and everybody's trying to understand what the heck's all in it and how do we make sense of it all and all that stuff. And I got a lot out of today, so I appreciate this information. For you guys out there, if you're listening to this, as we say on every episode, go share this show. It helps us continue to bring great guests on the show for you guys to bring a ton of value like Kaden did today. But also it's going to help you guys build your network, right? People are going to know you're in real estate investing. They're going to know what you do. They're going to want to talk about doing deals with you, bring you private money, whatever the case is. It's going to benefit you by sharing the show, and you're going to help out some other people. There's people out there we've had on this show who got an episode sent to them of maybe not our podcast, but somebody else's podcast or our podcast. And it helped get them started in real estate investing, and it changed their family's trajectory for generations to come. So please go out there, share the show, like, subscribe, do all that other fun stuff. If you are out there and you want to have a conversation about just getting started in real estate investing and you're not ready to get on the buyer's list, you can go to the contact us part on our website, put that information in, or just give us a call or text with the number on our website at wisconsindiscountproperties.com, and we will have a conversation with you and try to help you get rolling in your own real estate investing journey. So until then, guys, thanks for tuning in. We'll see you on the next episode.